My name is John Berlet. I currently reside in Rockport, Texas. I wanted to share a little bit about my background as far as real estate and my financial planning practice. Located in Austin, I started buying property at tax sales using a self-directed IRA in 1992. So I'm considered a bit of a pioneer in the self-directed IRA space. Went to the Travis County Courthouse steps in June of 92, had $26,000 in my IRA, and met only one other person was at the sale, an established sage attorney in Austin by the name of Walter Winland. So there's two of us, there's 13 properties, only 2 years worth of back taxes, so pretty minimal opening bids. And he told me, he said, young man, I was about 32 at the time. He said, whenever I bid, you don't bid. And if you want to bid, I won't bid. I said, okay. So we bought everything at opening bid. And again, only two people at the tax sale, which, it's probably only time it ever happened since. Of course, Austin, early 90s. What had happened, there's a community around Austin called Lago Vista, which Stormy actually lives in. And we'll talk about that. But the Japanese had bought the golf course, about 500 lots, the airport, and they got in troubles in Japan. And so the property started being sold. I bought 3 lots, I bought one for 1,100 and some change, one for 800, 2 of them on the golf course, 1 commercial lot. The $1,100 lot, all of them turned out to be a 10-year hold. I sold the commercial lot for 48,000 and some change. So you mathematicians do the ROI on that 10-year hold. Moving forward, 97, I purchased a 5-acre corner in Lago Vista commercial tract for $50,000, held it 10 years, sold it for $503,000 in 2007, right before the crash that got most of the U.S. Had a capital gain event, reached out to ended up buying an apartment complex in 2008 in Bridge City, Texas, which is, for those of you who don't know Texas, it's in what they call the Triangle, Port Arthur, Beaumont. It's also referred to as the armpit of Texas, not a real desirable place. However, Forbes magazine, all the jobs were in Port Arthur. It was actually, I read the article myself, named the second hottest real estate market in the U.S. next to Manhattan, New York, of all places, Port Arthur, Texas. So long story short, I bought an apartment complex, 24 doors with 6.5 acres to expand. 45 days later, Hurricane Ike made landfall in that area, and the whole city of Bridge City, Orange County, Texas, was underwater, including our apartment complex. So it was a value add rehab project from the get-go. We made out fine because we're fully insured. It's my first experience with the natural disaster. I've had a real estate license for 20 plus years. I have a passion for real estate, but it's not my profession. I had a financial planning firm in Austin, focused primarily on safe money, fixed indexed annuities. My clients were, done pretty well with their accumulation stage of life. They were more concerned with safety and preservation. Built up an annuity book of business, fixed indexed annuities starting in 1997 as well. And this product is pretty unique if you're not familiar with it. Your principal's protected. When the market's up, your account goes up. When the market goes down, your account stays up. So it's a safe money vehicle. I had a law firm offer me a chunk of money for my book of business in March of 21, right in the thick of COVID. So I sold my book of business and had a capital gain event. I've been hearing bits and pieces about opportunity zones. I decided to do a deep dive into the subject, bought a motorhome off the showroom floor in Las Vegas, Nevada, traveled 17 states looking at qualified opportunity zone locations all over the Southwest, up through the Midwest, up into New York, Pennsylvania, down through the East Coast, looked and had property under contract in Biloxi. Did not close on that. Came to Rockport, and then I'll give you the brief dynamics on Rockport, then I'll turn this over to Patrick so he can do a little education on OZs from a legal structure component. But Rockport was an eye of Hurricane Harvey. So 2017, half the buildings in Rockport, Texas were demolished and destroyed. And it's the second home of George Strait, If you call the city of Rockport, ask them to put you on hold, they'll play a recording by George Strait talking about how he loves coming into Rockport, Texas. So it's a bit of an anomaly. 85% of our counties designated low income opportunity zone. And after moving here and being here for a while, I realized it's because there's so many second homeowners who report their incomes in San Antonio, Austin, Houston, and all throughout the Hill Country. It kind of skewed the system because the governor's office, as many of you know, had to designate and IRS certified later in 2018 these census tracts based on 2010 census data, which was kind of old to begin with. But long story short, we have a beautiful destination location 25 miles north of Corpus on the bay. And it's the #1 fishing destination in the state of Texas. So we have acquired some property. We've got a ground up development going on that Stormy will speak to here in just a little bit. But regarding opportunity zones, I want to turn this over, introduce Patrick. He's a securities attorney and a business law attorney based in Grand Rapids, Michigan. And ask you, Patrick, to kind of give a 30,000 aerial overview of opportunity zones.
Well, thanks, John. I'm really happy to be here. I see some faces that I recognize from either the tax summit that Liz was good enough to ask me to speak on another topic, qualified small business stock. But this is great because a lot of, as John mentioned, I'm a securities lawyer, I'm a business lawyer. I do a lot of deal structuring around alternative assets, alternative investments, and a lot of tax advantage type deal structures. So opportunity zones fit right into that bailiwick. I had the opportunity to meet John and Stormy in connection with their project through an opportunity zone forum. And there are several out there. If anybody's interested in further networking in the area, just let us know and we can make those introductions. So I am going to share my screen real quick. So qualified opportunity zones came about in the 2017 Tax Cut and Jobs Act. And the idea was, the idea had been studied for the better part of eight years before that to address the challenge of 52 million Americans living in economically distressed census tracts throughout the country. And they tried to design a different kind of governmental solution rather than handout programs. And so they tried to do it through the tax code. And so they came up with Regulation Z in the tax code, or Chapter Z. And what the Opportunity Zone program does, it's an investor, a private investor incentive, not a tax break or handout, to private individuals or companies. And the incentives are based on reinvestment by an investor of a capital gain realized in an unrelated transaction from any source of asset to reinvest that in these economically distressed census tracts, either in real estate development, housing, or in operating businesses. The investments are geared toward newer improving projects, and they must be long-term holds. So they wanted it to make an impact in these economically distressed census tracts. The incentives are market-based. Investors will ultimately determine how large or small the program is. It's a self-executing program. There's no limit to how many gains can be deferred or other benefits can be realized in this program under the code. In addition, if one structures an investment as an opportunity zone investment, it doesn't exclude other forms of tax benefits and economic incentives from being usable in that investment or in that project. For example, the ones listed here, affordable tax rate programs, job training programs, new markets tax credits, investment tax credits, historic tax credits, et cetera, et cetera. So the idea was really, and there's a spattering of opportunity zones throughout the country. There's over 8,800 of them. They're in every state, and in most states have them in every county. So that's, let me just say here, in my brief conversation, we're going to talk about a couple of acronyms that I'll just point out here. QOZ's opportunity zones, QOF qualified opportunity funds, QOZP qualified opportunity zone property, qualified opportunity zone business property, and qualified opportunity zone business. So if you see these acronyms, they do have a meaning, and I just wanted to show you that it is acronym laden, this space. So this is Texas, where John's and Stormy's project is. There you can see the opportunity zones in Texas on this opportunity zone map. And here is the area in Corpus Christi and Rockford, the Coastal Bend area, where their opportunity zones that are that hold the Blue Zone Resort are. So the point of doing the opportunity zone investment, if it's done properly, and it's complicated, and there's a lot of hoops to jump through because it's the IRS, you get 3 tax benefits. Or you had 3 tax benefits, now you've got 2, but essentially with a bonus. The first is a deferral of the gain that was originally invested from an unrelated transaction. Taxpayer didn't want to pay a gain. Let's say they sold their business and had $1 million, like John's deal, wanted $1 million a gain. So it wants to defer that. Defer it till when? Well, the tax does need to be paid at the end of the 2026 tax year on what the original gain was deferred. So there is a payment of that tax, but it is deferred. There are ways to manage how to reduce that tax when it is payable in the 2026 tax year that we can talk about in the Q&A. In the early part of the program, there were 2 opportunities for basis step-ups. That is a discount on the tax that you would pay in the 2026 tax year. Unfortunately, the way they wrote the timing on that in the code, those basis step-ups are no longer available. But the big enchilada here is for an investment that was made, taxes paid on that at the end of the 2026 tax year on John's $1 million investment in gain, and he invested in a project which he has done and hopes to realize, let's say, 5 times appreciation on that original gain, and he holds it for 10 years. At the end of 10 years, he can either sell the project or elect to take a basis step up to that 5 times, and therefore 4x of that is going to be a gain that will be completely excluded, whether he just elects that or he sells the project. No more capital gain on that. Don't have to trade it anywhere. It's just gone. So that is a really, really big enchilada of a tax benefit that is driving this whole space. From a real estate standpoint, it's really important, sort of the prize in the Cracker Jack box, is that when you have a forgiveness or an exclusion of that gain on the back end after a 10-year hold, there's no depreciation recapture. So the gain is excluded and the depreciation recapture is excluded. So that's in a nutshell, that is the Opportunity Zone program. Real quick, as I mentioned, it is complex from a standpoint of understanding the rules and how you've got to make the investment in order to qualify for these benefits. And investors have to invest through this thing, QOF, Qualified Opportunity Fund, which can be a private or a public or professionally managed fund. It could also be your own do-it-yourself fund. And then that fund is going to invest either directly in Opportunity Zone property located in the Opportunity Zone, or a business that has a nexus to the Opportunity Zone. And the business could be a real estate development business. So there is a sequence that you have to go through to make these gains, the gain exclusion, which you're seeking at the back end, possible. I'll just point out, I saw Chris was on the call here, and he and I had this conversation in another call some time ago, that a lot of real estate folks are like, well, we've got 1031s. Why do we need opportunity zones? And there's actually a slide here, if you can see this. The big difference between 1031 tax deferrals, which are great in real estate and ought to be a tool in everybody's toolbox as their asset planning and investment planning. But with an opportunity zone investment, the gain and the exclusion that you seek to defer in the exclusion of the gain after a 10-year hold, that can be from any source: sale of a business, sale of stock, sale of Bitcoin. It doesn't have to be from investment or trade or business real estate. So that's a difference. Secondly, the proceeds of the sale of that primary gain don't have to be completely invested and quarantined away from your use. The Opportunity Zone project just says, look, you can only invest some or all of the gain, whatever you want, and you don't have to quarantine it. You just got to come up with an amount equal to what you want to defer, fund your QOF within 180 days of realizing that gain, and you're off and running. So that's a big difference. And then the other thing is, with a 1031, you can't elect to take a basis step up and exclude your gain after 10 years, but you can with an Opportunity Zone investment. So those are really the differences. Again, it's not, it doesn't exclude 1031s, but there definitely is a place for Opportunity Zone investing. So there's a lot more detail. I don't think I'll go into anything more at this point. I'll save it for the Q&A. But I think it'd be important, Stormy, if we kind of roll it into what does an Opportunity Zone real estate development project / investment look like from the ground up. Okay.
Perfect. Okay. Well, let me tell you a little bit about myself. And I know that I did this back in November, and I've met a lot of these folks through the not necessarily the Q&A, but the workshop, the calls that we've been on before and in the breakout sessions. So my name is Stormy Johnson. I do live in a town north and west of Austin called Lago Vista. And our claim to fame is we're a lake community with a drinking problem. So that can be a little entertaining from time to time, but great little town and area. So my background is that I had well, first of all, I started a small business. Like I said, I've met a few folks through the Royal, and I started an insurance agency over 25 years ago, over 25 seasons, because I'm also a football official. So everything's seasons with myself and my wife. And anyway, we had a kind of an issue in 2000 with this. It's a 4-letter word. It's called, well, I'll spell it, MOLD. So in 2000, and I had been in the industry 4 years in Texas, it came about that there was an issue. And so a lot of insurance companies were leaving the state of Texas, and there's nothing worse than building a book of business. And John can speak to this too as well. And now they've kind of pulled the rug from beneath you and saying, well, we're leaving the state of Texas. Well, clients used to read the newspaper back then, right? And there was this big article, Farmers Insurance Group is leaving the state of Texas. So my phone blew up, and fortunately and luckily, I was able to pivot at that point in time and keep myself in business. But in the meantime, I also purchased some real estate. Said, you know what? Real estate is something I'm passionate about. I love to do. So my first fix and flip was in 2000. Wish I still own that home today, but with the insurance industry being kind of goofy at the time, I decided to fix and flip and sell, and I did really well on that. So that was my first experience of real estate outside of the purchase of my primary home. Fast forward, I did some fix and flips along the way. Then I decided, you know what, why not buy and hold those, or buy and hold moving forward? So currently I have 2 short-term rentals, and I actually utilized a 1031 exchange from one of my fix and flips and put it into commercial property. So I have that experience in both real estate and the 1031 1031 areas of the tax law. So in 2000, I also got this thing called a securities license. So I've got a Series 6 and 63. I've done day trading primarily for my own account. I primarily used mutual funds and annuities, and set up IRAs, SEPs, simples, you name it. I've kind of done it. And thoroughly enjoyed working with the clients in that arena as well. Okay. So I was fortunate enough in 2021, is that right? Yeah, 2021, that I got a nice offer on my book, part of my book of business. And I had this thing called an asset sale. So I I opted to move forward with the asset sale. Make sure I got my date. Yeah, asset sale, and then sold a good portion of my book of business, and had a sizable, wish it was bigger, but a sizable capital gain in December of 2021. So I'd already talked to my CPA, and I had done some research, and basically he said, write the check be prepared to write the check for XYZ. And I was like, okay, well, I'll be prepared. So I started doing some research. One of the pieces of research is now I have a securities license, and I need to find a different broker dealer, but also how can I soften the blow on this capital gain? And I, just by sheer luck, coincidence, act of God, I reached out to John on something related to more of hanging my securities license, and we got to talking about opportunity zones and what that looks like. So I really had no knowledge of opportunity zones before talking to John. So and I had not actually come across John because I was a chamber president out here, and he was a member for a year. And so I knew the name, and I knew of Tandem and so forth, but I went ahead and started doing a lot of research in addition to that. So I looked across the country. I think Patrick, you made reference, there's only like 8,700 of them out there, right? So I did a lot of due diligence. First of all, what the tax ramifications were. Also, what type of opportunity zones. I was amazed at the variances of those. Some were operating, some were ground up, some were businesses and so forth. So I did a lot of research, and ultimately what it came down to is I put my boots, as we say in Texas, put my boots on the ground and went down to Rockport. Very familiar with the area. Have a short-term rental about 20 minutes from there. And I always call it the Sleepy Fishing Village, and went out there and took a look at it, met John, met his wife, and it really came down to the decision of, hey, I can touch, feel, smell, and I like this guy. So why don't, and there's a huge trust factor, right? So when you're writing a check to anybody, there's got to be a huge trust factor. In this case, you're writing a check to a fund. So anyway, what I was going to say is, my wife and I discussed it, and we opted to invest in the Coastal Bend Opportunity Zone in the fishing village of Rockport, Texas. I know Texas very well. I grew up here, went down to the coast, and thought, man, Rockport is a sleeping giant. So we talk about in the world of real estate, location, and quite honestly, John beat the run up of sand there in Rockport and ground up opportunity to look fantastic. So fast forward, John and I can continue to have communications, and I decided to come aboard to make this a successful project. I've always wanted to invest in multi-family or multi-unit, and this seemed to be a perfect fit in a perfect time in a perfect location. And what a beautiful tax ramifications. Okay. So as you can see, there is a picture of Rockport, Texas, and go back up, Patrick. So you have control, right? So just to reiterate, the fund overview, they're created in 2017. And as Patrick mentioned, it encouraged investors to redeploy capital gains from successful investments into new long-term investments. Struggling communities like 8,700 have been identified across the country. The fund that John has put together, we have a maximum of 25 million initial fund. It's under the Reg D 506C, the Coastal Bend Opportunity Zone Fund, LLC, and its affiliates. Does have experience and has invested in over 125 units of multiple land purchases valued over $4 million. I think, John, you made reference to some of those purchases. The Tandem Trust long-term investment strategy has a history of achieving exceptional and high returns. Now, the one thing that I did come across, and I want to reiterate, is that it does take a special collaboration when you're doing a ground-up development. So, as you can see, there's an art and science for ground-up developments, and that's where we're at. We've identified the four main factors. First and foremost, location, which, like I said, the timing was just impeccable. Right place, right time. Second factor is construction process itself. We're using ICF not only from an energy efficiency, but also because it is coastal. Cost efficiency is important, local market knowledge, and John lives in the area, knows the market, knows a lot of the powers that be. And the ability to work with the local government is also extremely important, which John has become very involved in. Correct me if I'm wrong on that, John. But no matter how good your project, if you can't get it approved, you can't get it done. There's integration of the design and construction teams, architects, general contractors, and obviously a lot goes into it before you pour the slab. Okay, and you want to have a building where people live and work. And we are building out the Blue Zone Resort and Conference Center. Now, I will mention this. Initially, the conference center was not part of the plan, okay? But you put enough like minds together and say, hey, you know what? Rockport is about an 8 or 9 month seasonal destination for folks that live and work in the coastal bend or in the state of Texas. And what's the best way to attract off-season, right? Off-season folks. Well, you go after corporate events. So you put in a conference center and you put in 60 doors. So they have a place to stay, have a place to meet. And guess what? They all love to go fishing and play golf. And so the corporate event venue or the conference center was put into place, and it actually is part of our name now, but not part of our logo quite yet. Okay. All right. So what we'd like to introduce, and actually Patrick is going to pull this up, is the pro forma of the Coastal Bend Opportunity Zone Fund. And we are going to focus on the Blue Zone Resort and Conference Center. So take it away from here, Patrick.
I'd like to interject a little bit more there on the area before you go into the pro forma, Patrick. Couple of things that are real exciting here to me locally is I was just recently appointed last week to the Chamber Tourism Development Council, and they are the oversight committee that manages the expenses, the hot tax that come from the state. And we're really a destination location. The population, 10,000 people. We have over 2,000 short-term rental units. So you can tell it's by far a birding community. Bird watchers love to come here. It's an dynamic art community. The art center, the courthouse, the city hall were all demolished in Hurricane Harvey. I think I mentioned earlier, it was the eye of Hurricane Harvey made landfall here. So there's a lot of federal grant money that's come in to rebuild this community. So the characters changed significantly. And our site is 3 blocks from the bay and 9 blocks from the downtown shopping district, art district. Go ahead, Patrick.
Okay, John. So, yeah, I mean, this is an opportunity zone project, but it is not unlike, other than the opportunity zone tax benefits, it's not unlike any other real estate development project, as Stormy mentioned. I mean, especially from the ground up. There's a lot of elbow grease that needs to go into it, and a lot of know-how and a lot of local knowledge. So, but you know, as in every real estate project, there is a involved financial model or pro forma, and opportunity zone projects are no different. And of course, these pro formas are projections. They're not guarantees. They're not predictions, because they depend on assumptions. It's an opportunity to illustrate, based on some reasonable assumptions, what an investor might want to look at as a potential return. And so like other pro formas that you've seen, again, with our project here, there's an input assumption page that we're looking to raise $6.5 million of equity in this illustration. The balance of the project for the Blue Zone Resort will be debt in a combination of CPACE debt, which is commercial property assessed energy savings debt, which is, we think, quite appropriate in this case, because as Stormy mentioned, ICF construction will realize a lot of energy efficiencies and be eligible for the CPACE side of the debt, as well as there'll be some just general construction debt to start, and then perm debt after that. So, these assumptions get put into, and a lot of assumptions about John's operating model and construction model and ramp up of the various revenue streams in the project. And those all go into all of the sheets above there. And then we see that there are various graphs and whatnot that we can see about our revenue assumptions and expense assumptions and how they look going forward over an 11-year hold in this project. We also wanted to make sure, in addition to our pro forma investment or income statements, P&Ls and cash flows and balance sheet, that we model again illustrated returns to investors out of an equity investment in this project. And so we do provide for that in this detailed pro forma. And I'm going to zoom in a little bit on this. In an opportunity zone investment, again, we model a long-term hold, at least 10 years, so that we can realize a tax-free exit from the project. So again, modeling to equity, $6.5 million. We modeled a cash reserve ongoing of 5% of net operating cash. We modeled a preferred return of 8% to the investors on preferential cash distributions until payout, return of the investment. We modeled on sale or refi distributions, because we do anticipate doing a refi, or at least applying some debt to the project before 2026 to be able to give a refi distribution, so those opportunity zone investors have some capital to pay their tax that is due in 2026. In addition, by having some leverage in the project, that will also allow them to take some depreciation already in 2026, which will actually have the effect of reducing the amount of capital gain that they'll have to pay on their original eligible gain that they invested in after the 2026 tax year. But John had put together in this projection going forward on operating cash flow and on sale proceeds, that the investors' rate after they receive all of their money back from distributions will continue to be 70% of the project. We again anticipate in month 48 a refi of the project at a valuation based on a multiple of trailing EBITDA. And then we have a leverage percentage that we don't want to get too aggressive and crazy on leverage during this interest rate period, of about 55% on an ongoing basis of debt to equity in the project. In terms of sale, we model 11-year hold in this illustration, and after that we illustrate a projected exit at a multiple of 5 times trailing EBITDA, and that would be an exit value for the project. So with the help of our wonderful accountants who were able to put this together, we go through and we illustrate what the uses of the proceeds of the offering will be, the equity offering, and then the refi in year 4, and we start generating some net cash from operation in the years that we hold, and then in year 11 we have a sale event. And so those items trickle down to what we call our waterfall here, and our net distributable cash to the investors, their total distributions, cumulative distributions, and then we can compute on that, again, an illustrated return based on these assumptions, which again may be different, in fact will be different based on actual results. But the project is attractive, which is why we're excited about it and think that it's worthy of a look. We're looking at a investor payback multiple from operating distributions as well as exit distributions of about just shy of 4.9. internal rate of return after completion of the project of about 25%. And, as I said, a 4.89 or 4.9 payback multiple. Now, if we take for an opportunity zone investor, because their gain from the project after their original eligible gain invested is paid in 2026, if you add back the tax savings on their exclusion of gain from the appreciation of that project, once it's up and cash flowing and is stabilized, then the multiple jumps from just shy of 4.9 to just shy of 5.7. And that's illustrated in these charts. So, there is a bump, a very big bump in terms of the total return of the project because of that exclusion of appreciation and capital gain on the back end of a 10-year hold in this opportunity zone project. I'll just mention that you don't have to be an opportunity zone investor investing gain in order to get into a deal like this. In fact, most of the projects that I see in real estate development and otherwise have both opportunity zone tax benefit seeking investors as well as those that just want to get in the project. As you'll hear in the opportunity zone community, opportunity zone tax benefits should not be a driver of investment, but should be, the prize in the Cracker Jack box, the icing on the cake, the enhancement of investment. And so I think that we have that, at least in an illustrated format, of what we're able to build at the Blue Zone Resort here in Rockport. So in the Q&A, we can take some more questions on that, and John and Stormy can elaborate. But that's kind of the way we do the financial engineering, much like a regular real estate development project, but with the little sweetener of the OZ tax benefits. Thanks.
Oh, thank you, Patrick. Let me add a couple of other items that are important. In our project, we have several multiple income streams because we have a qualified opportunity zone business that is the the Blue Zone Resort, Spa, and Conference Center. So we have a rooftop lounge. We have a more or less a middle to luxury resort with a spa. And the whole concept of Blue Zones is being designed after a city in Morocco called Chefchaouen City, where the whole city is blue. Now, I'll speak to that just a little bit. I proposed to my wife there in Casablanca, and we fell in love with this blue city. And they're thinking there, the Portuguese settled the place in the 1500s, and they thought they'd gone to heaven, and they decided to paint all their buildings blue because the skies were blue there. Now the belief is that blue repels mosquitoes. And it's absolutely the worst thing about living down here on the coast is these darn mosquitoes. And I'm thinking if that's halfway true, we're going to have a grand slam on our hands about the repelling mosquitoes. So we have multiple income streams. We have from the spa, argan oils, really unique. We're designing, the conceptual drawings are being redone, and I'll give you an update on our permitting process. We've submitted the civil site plan to the city of Rockport 3 weeks ago, and expect to have some review and permitting issued here any day now on our civil site plan. We've engaged, of course, the architecture. We have MEP and structural people, have not engaged them, but we've certainly have our bids, and we're leaning toward one particular firm to handle that. So progress is being made, and we hope to break ground in the summer of this year.
Yeah, just one thing I would add, and Patrick did make reference to it, is there is it doesn't have to be there are definitely benefits to being a capital gain. Okay. But I've been approached by folks that have real estate. I've been approached by folks with a Roth IRA that's pretty much stagnated or maybe even lost some value. And so those are all options as well. So it can be money out of the bank. It could be money redistributed accordingly. So again, like I said, my background was not only the insurance field, but securities. And those are also options in addition to obviously the ideal is the capital gain of some type. But and one individual said that the opportunity zone is like a Roth IRA on steroids or turbocharged. So pretty good analogy and very accurate.